So what are deferrals? Okay, aside from accruals, we will go to deferrals. In accounting, this means to defer or to delay recognizing certain revenues or expenses on the income statement until a later, more appropriate time wherein revenues are deferred to a balance sheet liability account until they are earned in a later period. So when the revenues are earned, they will be moved from the balance sheet account to revenue on the income statement. So for the meantime, for example, as there's a project, the project's not yet completed, you won't reflect it in the income statement. You still have to reflect it in your balance sheet. As a what? As a liability. Why? Because you still have to perform that transaction or that specific project. Once it's completed na, then you can bill your client. Okay, some deferred items for which adjusting entries would be made include prepaid insurance, prepaid rent, office supplies, depreciation, and unearned revenue. So the importance of completing adjusting of entries is to prevent inadvertent omissions of some adjusting entries. It is helpful to review the ones from the previous accounting period since such transactions often recur. Remember, class, in a certain company, there are transactions that are balik-balik or recurring. When it's recurring, it's better you check on the previous periods. By checking on the previous periods, you're able to know what needs to be adjusted. It also helps to talk the various people in the company who might know about the unbilled revenue or other items that might require adjustments. Okay, so how to record adjusting entries? The steps in recording of adjusting entries is almost the same with recording normal journal entries, except that you have to check the adjusting transactions. Say, for the system to recognize the entry as an adjusting transactions. So here, using SAP, you need to choose ADG transaction, period 13, example. Then this will be your point for you where you can do your adjustments. This is only an example class. So let's discuss about prepaid insurance. Prepaid insurance, how does it ano how do you explain about prepaid insurance? When you purchase insurance, normally you purchase on a premium of 1 year. You pay premium for 1 year. That 1 year period class doesn't mean that when you purchase it, it's already 1 year. No. So you need to understand that you purchase, you outlay money now, but yet you only need to record the specific expense right after when it's incurred. So the incurrence is not yet been done, but yet you already paid. So for example, 12 months prepaid insurance, end of the January, it will start 1st of January, end of December 31st. So end of January 31, that's a 1 month one. So you need to this decrease prepaid insurance account because it won't reflect already because you already utilized 1 month. So that's one of the example of the deferred item. How about prepaid rent? The same thing. If you paid your rent for in advance for 3 months and you only utilize 1 month, you need to adjust your balance sheet to from asset of 3 months after 1 month. Then you need to remove 1 month of it. For example, you paid 6,000 for 3 months. That means you already utilize 1 month. So you will have to reflect only 4,000 as prepaid rent. 2,000 is already rent expense. Then, your office supplies, for example, your office supplies you purchase in one bulk, 1,000 pesos, but actually in 1 month, you only utilize 100. So that means you need to remove 1 month, 100, just to correctly state your balance sheet, your information in your balance sheet. How much really is your asset left? So 1,000 minus 100, your office supplies as asset account is only 900. While depreciation, the same thing. Depreciation, for example, you have 1 million worth of asset. So your 1 million worth of asset may be depreciated for assuming 20 years. So every year you will have 50,000. But that 50,000 is not actually for the moment you step on that year. You won't be recording entirely 50,000. You have to adjust the 50,000 accordingly. How much is really the depreciation for that month? Because you need to divide by 12 months. So actually, in every month, you only expense of 4,166. And you need to depreciate only 4,166 per month. Accumulative, it's accumulated, then you will have the total depreciation for the whole year of times 12 months of about 50,000 already. That's how you must think. So it's a matching principle. You don't book certain figure that doesn't make sense. Okay, you have always to think logic. So if one thing is good for 1 year and you're reporting for 1 month, then you have to record only for the 1 month. Unearned revenue. Okay, so what is unearned revenue? Unearned revenue is you receive already the amount, but you have not yet delivered. Okay, you have not yet performed the job. So then when you perform the job, that's the only thing that you can recognize the revenue. Only when you have delivered or performed the specific contract, then you can recognize or project the revenue. Until that it is not yet done, then it's a liability. All right, so more or less, class, we have discussed what is necessary to be done. And I would like to give you more examples, but it's in your laboratory. Perhaps you can refer, I can give you more video tutorials for this in using SAP Business One. Okay, so see you again, class. Thank you so much. All right.